And welcome to another episode of Shut Up and Invest. And this time, as you guys have been asking for, we got the money multiplier segment that we do once a month, where we basically show you guys how to be your own bank, something me and Jory preach all day, every day. And we had to bring in the big guns coming in. Mr. Chris himself. What's up, my brother?
How are you? Thanks for having me back on.
Always.
Good seeing you, Chris.
You too. You too. It's looking awfully nice where you're at, as usual.
Yeah. We're in Puerto Rico. Kevin's in Miami. So if Kevin walked outside, I look a little bit nice too. I know you're in Minnesota. Oh, no. It's a little bit colder where you're at, though, in Buffalo right now, huh?
Yeah, we've had some good weather. It just depends on the day. I could walk outside. It could be snowing. I could walk outside. It could feel like summer. That's Buffalo.
Not my flavor.
Oh, man.
Guys, today,
Hey, I want to just...
Go ahead, Jay.
Oh, no, I was just saying, on the 15th, my little policy payment goes out to Mass Mutual. So that went out yesterday on Monday, and it's a good feeling when we just see that little cash value keep building up and up and up. So,
yeah,
sorry,
absolutely.
So essentially, you said yesterday you funded your own bank is what we're talking about.
Funded my own bank. Yep, 100%. Yep. Yesterday, I put my own deposit into my own bank account. Feels good.
We're going to be talking about today exactly that, exactly how to basically take your own private banking system, personalize it. Chris is going to show us how to use this to lend money, to buy real estate, to be able to drive your own personal corporate car, and all these bells and whistles that we're just learning, me and Jory, with the mentorship of Chris, of how to be able to essentially be our own bank, not just for real estate, but there's a lot more to it, right, Chris?
There's a lot more. And I'll tell you, we kind of burned the midnight oil on this one because we came up with something that we love, and I can't wait to show it to you.
Let's get
into it. Awesome. Let's get started.
All right. Let's jump right into this. So I'm just going to share my screen here. There we go. You guys can see that screen, right?
And it is. There you go. Here I go.
Bingo. Oh, hang on. Darn it. Multiple screens. There we go. Now we got it going on. So, all right. So what we're going to do is I'm going to really kind of walk you guys through what we were talking about creating your own bank and about walking, through the different life cycle of how to actually use what we call the money multiplier method. And, I'm not going to spend much time on this, but you got to really look at yourself in the mirror and you got to ask yourself, are you part of the 5% or are you part of the 95%? Because, I hope that you're all part of the 95 or the 5%, not the 95, because if you look right there, that'll show you what I mean. Social Security Administration, out of 100 people, only 5 of them are going to be financially secure at the age of retirement. And I wouldn't be surprised if these numbers are going the opposite direction. I bet you the next report they put out, it says 4 out of those 100 people are financially secure. So now that you know where the numbers came from, are you the 5 or are you the 95? I hope you're the 5, because what we're really going to get into is simple banking concepts, how you can build wealth without having to work any harder, without having to work any longer, without having to take on excessive or unnecessary risk, and without giving up control. But the problem is, just like in the prior shows, I've been teaching you the number one thing you need to do is take back control, because right now we're all taught to make our deposits into someone else's bank. That's what we're taught to do. We're taught to put our money in someone else's bank, and someone else's bank doesn't like deposits when it just sits there. So what do? They move that money the same way we should be moving our money, but the bank takes our deposit, gives us interest on that money, and loans that money back out for people to buy homes, loans that money back out for people to buy cars, loans that money back out for people to remodel their homes, kitchens, bathrooms, and man caves, all the same. And they lend our money back out to pay off debts and debt consolidation loans. And in doing this, what they do is they make a spread the whole time on what they're paying us and what they're earning. They make a spread the whole time. And if we did the math, the bank would appear to have made 20% on our deposits. Now, some of you might be like, well, that's just the nature of the beast. We're using the bank's money. No, actually, you've got it all wrong. You see, the bank isn't using their money. They're using our money to do this. But the other problem is the bank made 500% more than you did. 4% you're getting, and the 20% they're making on your money and everybody else's. If you divide 4 into 20, they're making 5 times more, 500%. So the real important thing to take out of today is, how do we mimic what the banks do? Because if you can figure out how to mimic what the banks do, and I can show you how to do that, and folks, this is maybe a bit advanced if you haven't seen the original presentation, but the original presentation shows you how changing just one thing can change everything. And that one thing is where your money goes first. Is your money going to go into someone else's bank where they make 500% more than you do? Or is your money going to go into your own bank and you then control the flow? Just like Jory just said, right? He made his deposit into his bank, which represents this little green square. And that stands for the money multiplier policy. And what is that policy? Like, what are we talking about? What is your bank? Well, we talked about it before. Your bank is nothing more than a specially designed and engineered whole life policy. And that specially designed and engineered whole life policy is built completely different than any whole life that you've ever seen, because that one that I'm talking about, your bank, okay, because that specially designed and engineered whole life, this money multiplier policy, is nothing more than your private bank. And that's what Jory was saying he made his deposit into. But now what he's got to do is he's got to move his money the way that the bank moves our money. So here's how it works. And I just want you to understand the concept. Now, this is actually my policy that we modeled this after. So these are real numbers. My policy, I made a deposit of $30,000. Now, it doesn't matter how I put that $30,000 in. One time, every single month, I could deposit it until it gets to $30,000. But when it was $30,000, what I decided to do is I decided to take money from my private bank and then pay off their private bank or their bank. And how I did that is I had a line of credit, and I used that line of credit for real estate. It's exactly what I did with it. It was with a local large commercial bank here in town in Buffalo, and I was using their money to renovate my homes as we did flips. And I was paying them 9%. 9% interest is what they charged me on this unsecured corporate line of credit. And I said, you know what? I don't want to pay their bank. I want to pay my bank. So I took a loan from my private bank, which the insurance company charges me 5% to use my money. I put it into this middle. So just so everybody knows, this segregated bank account, don't get hung up on that. That's just a regular bank. Okay. This is just my money going from my bank into a separate bank account that I created for the purpose of just doing what I'm going to show you. So all this segregated bank account is a new checking account that you go and you open that's designed to do nothing other than what I'm going to show you. Now, what I then did is I then took the money out of that segregated account, okay, the 23 grand, and I paid off that line of credit. That's all I did. I just paid off their bank with money from my bank. Sounds pretty simple, but see, it doesn't end there, because every month I used to pay monthly checks to their bank, and I don't like paying their bank. Okay, so I paid them off, and now I'm going to make those monthly payments of $289, which what that is, $289 a month was the interest at 9% on my $23,000 line of credit. Now I no longer owe $289 to their bank. So what I'm going to do is I'm going to change the name on the check. That's it. That's all I'm going to do. Instead of writing, the name of the bank was Key Bank. Instead of writing Key Bank on the check, I'm writing the Bank of Chris. And then what I'm going to do is I'm just going to flow that money back into my bank. You see what happened here? All I did is I just recaptured and recycled the money that I used to give away to their bank, and I recaptured and recycled it back into my bank. And in doing so, I made money. But I didn't just make money once, I made money twice, because my bank, this specially designed and engineered whole life, is paying me a guaranteed 4% plus dividend. And it works out to be 6% by 2021 numbers. So I'm making 6%. To take my money out of my bank as a loan, in other words, for the insurance company to give me a loan on my money, it cost me 5%. And some of you have a problem with that. You're like, oh, why would I pay 5% to the insurance company for using my own money? Silly rabbit. You do the same thing today. You use the bank's money, don't you? And you pay them interest. Okay, same idea, except for the difference between the way you do it today and the way I'm doing it is that 23 grand that I took out as a loan, it never even left my account. Therefore, my 23 grand is still in my account, earning 4% plus the dividend, while I take the insurance company's money, not mine. Mine's nice and cozy in my private bank. And I use the insurance company's money, the 23 grand that you're seeing on the screen. I use their money, and all I'm doing is I'm using their money at 5%, and I'm paying off a line of credit at 9%. So you just do the math. I made that spread, but I get all $289 of that money back into my bank instead of losing control of that money every month. So now let's kind of keep walking through the flow. Now that I explained that, let's talk a little bit about returns. Everybody's like, well, how much are we going to make? And you can see there's a little disclosure at the bottom we threw in, but here's my account. I put $30,000 into it each year. I have the ability to fluctuate the amount I deposit from 30 down to the low of 12 and back up to 30. But let's just assume that I put 30,000 in for a period of 10 years. And then after that, I just drop it down to 12,000. That's what we're going to make an assumption here. In the 5th year, I put 30 grand in. You can see there, non-guaranteed cash value increase. That's how much my 30 grand made that year. And you guys are looking at that, right? I put 30 grand in year 5 and I made $33,000. That means if I take 33 minus 30, I made a difference of $3,028. You guys realize that's a 10.09% cash on cash return on my money? Is your bank paying you 10% on the money you're depositing there? I don't think so. Okay, and how much money did I have access to? Well, most people would just look at it and say 100%. I should have access to all the money. No, I have access to 110% by the math. And then we just keep going. Year 10, I put in 29.9. I have access in that year to 38,000. Think about that. If you went to your bank, okay, this is 10 years from now, but if you went to your bank and you gave your bank 29,900 and you came back, I don't know, 1 month, 3 months, 6 months, 12 months down the line, and you took out roughly $38,000, would you feel like that would be a good day? So your 29.9 made you $8,961. That's a 29% cash on cash return. You had access to 129% of the money you deposited. And it just keeps getting better, folks, because you know what? When you create your own private bank, it's going to work just like this. There is no real deviations in this. The only thing that's non-guaranteed, as the little disclosure says, is the dividend, but 4% is guaranteed. The dividend only amounts for 2% of those numbers you're looking at. And these companies, especially this one, has paid dividends for, I think, 168 years. Not really too short of a period of time. But here's my numbers, my policy, my numbers. But see, that's boring to me. Just looking at these numbers on the screen, you guys might be like, wow, that's incredible. 29% return, 143, 412. Yeah. But you know what? I'm in this business to control my money and to move my money. So I didn't move my money here. This is just showing my money sitting idle. And we never want to leave our money sitting idle because lazy money is exactly that. It's lazy. And all of you are very good at making money, but you got to start getting good at making your money work harder. Your money should be out there working and making more for you than you are. That's how the wealthy do it, folks. There's only so many hours in the day. And you can work as hard as you want, okay, during those hours in the day. But once those hours are done, your earning potential that's it. That's all you can do. And until you start learning to make your money work for you, that's when it becomes infinite. That's why the whole concept that we're talking about is called the infinite banking concept, because it truly is infinite. So how am I going to move this money, right? So I just said that's my returns without moving it. What's it going to be if I move it? This is where this gets super fun. So stay with me, folks. Here is uninterrupted compound interest. This is how this works. So if I started with a traditional savings account and I had $73,000 in there, but I took a loan for $27,000 out of that traditional savings account, okay, that's one way. How much money would I have? Literally, if we did that, wouldn't it be, and let me just, I can't draw on this one. If you took 73,000 minus 27,000, that's how much money would be in your traditional bank earning interest. But you see, in my policy, when I take a loan, okay, I still have the full 100,000 working for me. I don't have 27,000. I have 100,000 working for me. That's the difference. If I got 100 making uninterrupted compound interest, Or if I have 73, which is the amount 100 minus 27, and I apologize, the slide needs to be updated. It needs to show 100 minus the 27 gets the 73, but we just threw this together today. And you also need to have a why. Here's my why. This little one in the middle here, that's Vivi. She's now 9 months old. And I'm going to show you what this policy is going to do, what my why is, and how I'm going to benefit her with my why, but also make a lot of money in between. So here's how we're going to do it. First thing I'm going to do, somebody's going to come to me and they're going to bring me an opportunity. And that opportunity is going to basically be to lend them money. So Jory's got a real estate deal, or Kevin's got a real estate deal, and they need some money for that deal. They need to close on that deal. And they come to me saying, hey, Chris, I need a little bit of money to close on this deal. Can you help me out? And I say, sure. How much do you need? I need $25,000. Great. So what I'm going to do is I'm going to go click one button in my private banking portal, and I'm going to take a loan for $25,000. Now, remember, if I had $87,970 in there and I take 25 out, how much am I earning interest on? If you guys remember the last slide, the full 87,970, because that 25,000 I took out, that wasn't my money. That's the insurance company giving me an advance of my death benefit. They're literally making me a loan from their general account. And all they're doing is they're saying, okay, someday when you die, there's going to be a death benefit paid. We're just going to subtract it from that death benefit. And again, folks, if this is kind of high level, just remember, we just did a training last month that explained this concept at its simplest. Now I'm going advanced on you. So we took 25 grand out and I lend that to Jory or Kevin, whoever needs the 25 grand. Heck, maybe they both need it. I make two loans, all the same to me. So we got 25 grand and I loan that money out at 12%. That's just the rate that I charge, 12% simple interest. So if I was paying 5% back to the insurance company and I was loaning it out at 12, there's a spread there, right? But then Jory or Kevin or both of them are going to pay me interest of $250 a month. 12% on 25 grand is $250. And then I'm going to take that money and I'm going to make a spread of $145.83. 12 minus 5 equals a spread of $145. So they're paying me $250, but I get to literally profit $145.83 above and beyond what the insurance company is charging me. But there's one piece here that you're not seeing, and that is the fact that I'm still earning interest and dividends on the full $87,970, which I already showed you the returns on that prior slide. If you guys remember in the prior slide that I did, I'm just going to go back to it because I want to make sure you guys are following me. Here's the returns I'm earning with that money just sitting there. But now I'm going to make money on top of this, which is what I'm showing you all how I'm doing, which is right here. So this 145.83 is on top of those returns that my policy is earning, because my policy will earn those returns I showed you, whether or not I take all the money out or leave all the money in there. So if I could take all the money out and make the same return and only have to pay 5% in between, well, then this starts to make a lot of sense. So now that's the first loan I do. But then they pay me back that loan and I'm really bummed out. I'm like, well, you really should have just kept the loan and just kept paying me interest. But they're like, no. We paid you $250 long enough. So now what I do is I got to go find somebody else. So I find a guy named Jim, and Jim brings me a deal, and Jim needs 50 grand. So I'm pretty psyched. Now my policy's got 152,000. And these are real numbers, folks. I'm not making these up. This is actually my policy in the life cycle, which I'll show it to you in a moment. So I make a loan for 50,000, take that from my policy. The insurance company gives me 50 grand. They subtract 50 grand from my death benefit, and they continue to pay me interest and dividends on 152,000. And all they do is they say, hey, listen, at the end of the year, pay us 5% on that 50 grand if you're still using it. I loan that money out at 9%. Now let's just pretend that this is a family member, because I don't lend money at 9%, but I didn't want to do 12 and then 12 again, because you guys would be like, oh, how come it's always 12? So I switched it up. I want to charge 9% to my family member who's borrowing the money. They're going to pay me $375 a month. I'm going to profit $166.67, and I'm going to take, after the loan's paid off, and put the 50 grand back in. You see what's happening here? If I just drew a circle, all I'm doing is I'm just moving money from the left to the right, and then in monthly payments, taking the money from the right back to the left and paying the loan off and making a spread in between. Now, this is another real story. This isn't in a chronological order, although this is my policy. I'm just doing an example, but this is a real example. Okay, this is my wife's car. So when when we found out she was pregnant with Vivi, I guess you're supposed to get your wife a push gift. I never knew these things. Do you guys know you're supposed to get push gifts when they have children? Like that was
No.
yeah.
I got a lot
Okay.
of kids. Never did that, Chris. I think you got played on that one.
I
never had to do that.
certainly listen. I got played. I got played out of $63,000, guys. Like she made a big deal of this push gift. She says, "Look at this is what all husbands do." So, well, we did. She needed a new vehicle. I wanted to get her a nice, safe vehicle, so I bought her an SUV for $63,000. So all I did is I had $218,000 in my policy. I clicked the button on the online portal. The insurance company gives me a loan for $63,000, subtracts that 63 from my death benefit, and charges me 5%. Again, don't get hung up. This segregated account is just a stopping place, folks. Books and records, that's all I want you to think of. It's a bank account at my local bank, actually Key Bank, and it's just designed to hold money in all these things I'm showing. I then take a loan, and that loan, well, how did I come up with 4.5%? Well, I went to the Porsche dealer, and I asked them, to run some numbers on financing, and they came back, and the best deal they would give me to buy this vehicle for my wife's push gift was a 4.5% loan. So then when I told them, I said, all right, well, let's do this, wrap this up, let's get this car bought. They push all the loan documents in front of me, and I'm like, what are these? And they're like, well, these are the financing documents. You need a loan, right? I said, no. I said, I don't need a loan. I'm paying cash. And the guy looks at me very strange. He's like, so why did you have me going back to the finance manager back and forth to get the best loan rate if you were going to pay cash? Why didn't you just tell me you were going to pay cash? And I looked at him and I said, because somebody had to do the math to tell me how much I should pay my bank. So that's all they did is they did the math for me. And my monthly payment was $1,084. Now that $1,084 I would have just given to that bank they were running me with, which is called Bank or M&T Bank. And now I'm just making that payment back to myself. And over the course of 5 years, I will have recaptured $9,758 in interest. Now, if you guys are looking at that $9,758 wondering, well, what the heck is that number? That's just the money you probably today are giving away to your car finance company. Whoever's financing your car, you're paying them a payment every month. And in that payment, there's an interest charge. And that interest charge over 5 years on a vehicle like this at 4.5% is exactly that much. I just didn't want to give $9,758 a month to M&T Bank when I could just give it to the bank of Chris. And that's all I did. So you guys see what's happening. All I'm doing is I'm showing money going from left side to right side, back to left side. I'm just moving my money. And the whole outcome of doing something like this is going to work out like this. Okay, so all I'm doing is I'm showing 30,000, 12,000, and then, so I'm sorry, what this slide's showing is, remember, in my policy, I was putting 30,000 in for the first 10 years. But in the 11th year, I'm not going to be able to put 30,000 in anymore. I can only put 12,000 into the policy. Okay, and the reason for that is not important for today's training, but it's just an IRS rule. I can't put any more money into the plan in the 11th year. I can't do the full 30. I can only do 12. But how many of you have ever set up a savings plan? You just get used to it, right? That 30 grand or however I'm putting it in, you just get kind of used to saving that money because you weren't spending it for a period of 10 years. So what I'm going to do is I'm going to continue saving it. But I'm just going to take 18,000 and I'm going to just start saving it, not in my policy because I can't put it in there anymore. I'm just going to start putting it in that segregated bank account that I set up. Okay, so that's all I'm doing. I'm just showing you that. Now,
hey, Chris, quick question.
Please.
At that 11th year, right? Does your policy premium go down to that amount per year moving forward, or you don't make any more payments into the policy after that?
That's a great question. So my payment goes down to 12,000. So the premium deposit that I'm making into it goes from 30 down to 12. And if you remember from the earlier slide, I showed that, but I mean, it's just hard to follow all these numbers. So if you see that right here, see how it goes down to 12. So that's all that's happening. I'm going from, well, we'll just call that 30, 29.9, and it's dropping to 12. Now, could I reduce that to 0? Yes. But let's just think about that. Let's say you had the ability in year 11 to go from 30 down to 0, and you're like, oh, I don't have to put this 12,000 in anymore. I'm not going to. Do you realize what you'd lose? Let's just look. I don't have the 11th year, but let's look at the year 15. I put 12 grand into my bank, okay? And I'm just making that. Do you realize that I made 17 for putting 12 in? So just from the math, how many of you would find a way to make a $12,000 deposit into your bank if you could go right back to your bank 30 days later, 60 days later, whenever, anytime after your check clears, and you could take 17,000 out of your bank. So Jory, if you could put 12 in your bank today and then go back to your bank and take 17 out, would you not put the 12 in, or would you put the 12 in?
Oh, I put it in. Definitely
Exactly.
put it in.
So same thing here. So that's all. And I get that question a lot because people, for some reason, continuously want to look at this like this is a payment. But I don't know how you can look at those numbers there and see that this isn't a deposit. This is a deposit, not a payment. If you were making a payment, would you make 3,000, 8,000, 17,000, 12,000, 27,000? No. You know, if it was a payment, the money would be gone forever. But when people think of whole life insurance, they think of making premium payments. And folks, that's a mental thing. We got to start looking at this like you're creating your own banking system, which means you're making deposits into your bank, not somebody else's bank. And you're not making premium payments, because premium payments are just money that's gone forever. You're making premium deposits, which is why I'm showing this here. It's why I'm showing that I've got 12,000 going into the policy in the 11th year, but I was used to doing 30. So I'm just going to take this 18 and I'm just going to pop it over into the segregated bank account. So now this is where it starts getting really fun. So let me share from this current screen here. All right. So Vivi's going to go to college. And when she goes to college, I don't want to, well, what the heck here? That's a bit of a delay there. There we go. When she goes to college, I don't want to take out financial aid loans. I don't want to, take any of the college loans out, because I know how they work and a lot of people get trapped by them. Now, some people are like, yeah, but the government's going to pay those off. Okay. Yep. Keep holding your breath. But maybe they do, maybe they don't. But what I'm going to do is I'm going to fund college from my bank. So here we go. This is how I'm going to do it. I'm going to take a loan when Vivi's ready to go to school. Okay. Listen, I might be way off, guys. I'm new to this whole, child thing and college thing, but 20 grand a year. How far off am I from college? Is college 20?
Some are 20, some are 50, some are 10. So you're in the middle. You're about in the middle.
Okay. So I'm not too far off. Now I think in 18 years from now.
You said a year or semester? Is that a year or semester?
That's a year.
Okay. So that's a pretty cheap college.
Okay, so we're going to have to up the numbers. But anyway, these are just the numbers that I was guessing for this training here. So I'm going to take 20 grand out each year, a total of 80 grand over the 4 years she's going to go to school. And I'm going to put that money into the segregated account. And then all I'm going to do is I'm going to pay for her school. And again, don't get hung up on the numbers. Obviously, I'm going to have to put a lot more money than that into this account for it, but we have it. And if you remember, I was putting that 18,000 that I used to put in the policy into my segregated account. So this bank account's got 144 grand that's built up in there. Now, let me be clear. I would never actually do it this way. Okay, I would have started another banking policy. I would have never allowed 144 to build up in somebody else's bank. But I'm just trying to give you an example to keep it very simple. But just realize in real practice, and Jory and Kevin both know this, I'd never keep that 18,000 going into this bank account. I would have started one or two more policies. But I'm just showing just one policy's life cycle. So now that 18 built up to 144. So what I'm going to do is I'm going to repay this $80,000 in loans out of this cash that's here. Now, why would I do that? Well, because if I'm paying 5% interest on the 80 grand that I used to pay for the university, well, then I want to try to find a way to get money out of their bank into mine. And this just gives me another way to move my money. I get to take 80,000 plus interest that I charged myself of 85.6 and move that money back into that same existing policy. Because remember, I'm showing you just one policy. I have 7 of these things, okay? But I'm just showing you one so you can see how money is moved. And I captured $5,600 in interest because I charged myself 7% on those loans. Why? Because I figure that at that time when Vivi goes to school, interest rates probably, even though they're not today, but Vivi isn't going to school for 18 years or 17 years. So loans are not going to be what they are today. They're going to be more. I just pegged it at 7%. So just forecasting in the future, this is planning. And that's, if you guys are going to get good at, money and everything else in business, you got to do a little planning. And sometimes your plan has to change. This plan will likely have to change because clearly 20 grand, I think that's going to send her to probably the worst possible school that you could ever send your kid to by the time she's ready to go to school. All right. So now here's the recap. So all I want to do is I want to show you how much money I made in doing all these different things. Now, remember, I made money on the policy the whole time, but I want to show you how much interest I made by doing those private loans. So I made $3,000 in interest on the first loan, which was $250 times a year. Okay, or $250 a month, which was 12% on 25. Private loan number 2 at 9%, I would have made $4,500. And then the car that I bought Larissa for the push gift, 63 over 5 years, I made $1,040. Now that's net. I just want you guys to understand that's net of the 5%, because remember, I only charged myself 4.5 and I was paying more than that. So you're just looking at the net of what I paid back in net. So all that really shows you is some people would have done the math. They would have said, wait a second, the math doesn't work. You were paying the insurance company 5% on that 63,000, but you were only charging yourself 4.5. How does that work? You should have lost 0.5%. No, folks, what you don't understand is how compound interest works. You see, I still made $1,040. This is true math. We run calculators on all these. So behind these numbers is a very intricate mapping process that we do for all of our clients to basically show you how math actually really works, not what you think or how you've been taught math works. This is how it works. I made $1,040. And then college, if I charge 7%, which could change depending on what they're charging, I made 56. So the total interest recaptured was $14,140 plus the interest and dividends that I made. And just in case somebody has already forgotten what that was, there's the interest. So there's the money I made on the policy. I made all this regardless, no matter whether I did anything or not. I could have just sat back and done none of that stuff I just showed you, and I would have made these kind of returns each and every single year. But again, I call me a go-getter, call me whatever you want. I just like moving money, and therefore I made an additional $14,140. And if I go to this slide, let me just blow this up because there's a lot of numbers on here. All right, so if I blow it up, here's my policy. These are my real numbers. Cumulative cash value, okay? Segregated account. Remember, this is that money going into that separate bank account. Segregated account balance. Remember, that's what I used for the college repayment. Here's the loans I took, 25, 50, 63. This is loan number 1. That was the loan to Jory. 50,000 was the loan to Jim. 63,000 was the loan for the car. And then 20,000 each year for college. But I paid all that back. And here's the interest and the loan repayments I paid back. Took 25 out, but I made 28. Took 50 out, made 54. Took 63,000 out. You already know all the math. So now look at my cumulative cash value. So by the time I'm 65, $722,000 has been built up in my account, in my bank, not somebody else's. Normally, I would have given a bunch of this money away to somebody else's bank, but I got to keep it all. And I got to make uninterrupted compound interest. So now what happens at age 65? Well, lots of things. Some people die. Some people decide, I don't want to work anymore, and that's going to be me. So we're going to call this section my retirement years. Now, here's the math. Again, you just saw it. Up to this point, 22 years into this one policy. And again, anybody that ever gets into the infinite banking concept, I would find it extremely unlikely and not probable at all that somebody would only have one policy. I'm only showing you one policy. To date, right now, I have 7 of these things. I'm only showing you one. So you
How many, Chris? How many did Nelson Nash have?
Oh my God, what was it? It was like, was it 20 something? I'm trying to remember the number he had.
I think he had in the 30s. I think it was
in the 30s. Brent Kessler has 19. So I'm chasing Brent, right? He's got 19. I got 7. I got a couple years to catch up to him. Now Nelson is no longer with us. He had 30. All I can tell you guys, I'll beat Nelson's. So if he had 30 something, I got lots of time left. So every year I add 1 to 2 of these. I just started a policy for Vivi actually 2 weeks ago. I started a policy for her. So that actually, if you take my whole family, I've got 7 myself, 3 on Larissa, 3 on my mom, and now 1 on Vivi. That's my total banking system. But I'm only talking about 1.
And the reason is, right, because you can only put so much into each policy. So You have all this other money. When you do this, you don't want your money sitting in the bank at all. So you have to put all the money you can into more policies, so you get more policies. Correct?
Dude, you absolutely nailed it. Now, if the IRS tells me, with the MEX 7 pay rule, I can only put X amount of dollars into one policy, like you saw it, 30,000 is how much I decided to put into this, but eventually they're going to tell me I could only put 12 in. That's not good for me. I want to put all my money through this system. So as I make more, or as I take more money back from everybody else that I was giving it away, like Visa, Amex, the car, companies taking my monthly payments, as I take that money back in my household, I just have more money. And I want to put it all through my bank instead of through their bank. So you nailed it, man. You nailed it. So you will never, ever stop adding policies. It's not that I want 7 of these things. It's not like I, wear the proud thing saying I have 7 policies. It's just the nature of how this works. You will never just have one. But all I'm showing you in this training today is just one, because it's easy. Otherwise, it just gets too complicated for me to explain. So this one policy, when I'm 65, I put $443,000 into it over 22 years. Okay. My cumulative cash value is 722. You just saw that in the prior page. My cash on cash return in the 22nd year is 265%. That's how much my money is going to make that year. And my cumulative return for all of those, penny counters that are saying, well, no, from day one, he put in 30,000 for 10 years. Then he did 12,000. He didn't make 265. No, silly. I made 167. Sorry. I know that's not a very good return, but you guys know I'm joking. 167.3% cumulative return. By the time I'm 22, what does that look like? That looks like money, baby. That's what that looks like. So let's look at what that looks like, because now I'm going to retire. And when I retire, I'm going to start taking money out. And you know what I'm not going to do? I'm not going to put it back, because I don't care about recapturing and recycling money anymore. All I want to do is I want to sit on a beach. I want to go out and surf when the waves are good. I want to come back and have my fish taco, and I want to have my cold Corona or whatever I decide that day sitting on the thing. So 93 grand from this one policy, 100% tax free, is not a bad income. Shoot.
Sorry to interrupt you. We do have a question. They're asking, how do you know when to start a new policy?
Great question. Man, that's a great question. You know when to start a new policy when you look at yourself and you say, man, I wish I would have put more into that last one. For example, that one that I was showing you right here, I was putting 30,000 in. Let's say after I get into this thing and I'm thinking, oh, wow, I wish I could put more than 30,000 in, because for some reason my bank account over here has more money in it than I want to see, because I don't want a bunch of money sitting in someone else's bank. I want it in mine. And if I can only put 30,000 a year into this policy, well, all of a sudden I have a realization and I say, bing, that light bulb goes off and I say, I need another policy. Now, another policy is, I want you to not think of another policy as another policy. I want you to think of it like a bank would think about a branch office. If a bank opens a branch and all of a sudden they get a bunch of customers and they're doing really well, the bank does what? They open another branch. How many of you in your town have seen new branches of the same bank open on multiple street corners, right? All of you have. There's one right down the road from my house that just opened. I'm like, why did they need another office here? They got one right at the other end. 2 blocks away, there's another branch of this same bank. I'm like, why are they opening another one? You silly rabbit, they want to raise more money. So I want to start more branch offices too. So I don't look at it as another policy. I look at it as another branch office that allows me to put more of my capital into that branch office and move that darn money the same way. So that is a wonderful question. Keep them coming, please. So I'm retiring. Okay, $93,000 is the amount I'm going to take. Now, how did I arrive at $93,000? Well, I ran a calculation. Our team, our mapping team, who all of our clients have access to and that get to use for free, said, you know what? Based on your cash value, the 722, and the growth that you're going to get each year, you can safely take out $93,000 every single year and never run out of money until you're 100. And I said, great. So all I'm going to do, you can see this little thing here. There's 2 ways to take money. You could take all loans, or I can just surrender the amount of cash value I have right down to the amount that I put into it, and then take loans after that. And that maintains the tax-free status. Because did I mention that already, Kevin? Did I tell everybody that this $93,000 is 100% tax-free? See, I don't like giving the government money. So these policies, I forgot to mention, are tax-free if built properly. So all the money I'm taking out here, if done right, which is how I do it right here, it's all tax free. So the other thing I said I'm not going to do, I'm not going to put any money back in. None. No money's going back in. And how's that going to look for me? Just like this. So here's my retirement years. 93,000 out each year until I'm age 100. I'm going to keep making those $12,000 deposits. And if anyone's asking, well, why would you keep making $12,000 deposits in retirement? I thought I wouldn't want to save anything. Remember back to when I asked Jory, would you put 12,000 in if they gave you 16? And he said, yes. But now we're like 23 years into this thing. So I don't know what the math was there. So let's just try this. 25. Would you put 12,000? Would you make a deposit for 12 grand? And if immediately they gave you back 38,000? Okay. I don't think anyone isn't doing the math properly on that one. So there it is. So that's what I do. And also you can see here, here's my net cash balance. I don't run out of money. 99, 100. I still have $114,000 in cash value when I'm age 100. Plus, you know what else isn't shown on here? And we very rarely talk about it, but it's there, a death benefit. Even though I've used all this money, I'm still going to have a few $100,000 in death benefit so that when I croak, or as I like to say, graduate, there's going to be a death benefit passed on to my beneficiaries. And the death benefit will be comprised of the original death benefit in the contract, plus or minus whatever cash balance I have in there. So it's a combination. So that's my policy. That's my life cycle. But now I got something. This is how we doing on time, guys?
Got about 15 more minutes.
All right, perfect. So this is something that I literally read in a book. I read this book. It's the most dry, boring book. I don't expect any of you to read it. It's called How Privatized Banking Really Works. It was written by an economist. And if you've ever read an economics book, you probably get 5 pages in and you fall asleep. Well, this book's like that. But at the end of the book, it told me and showed me the most unique thing that I think I've ever seen. It showed me how I can buy cars and then lease those cars to my company, my real estate company, and I can drive a company car. But see, when you drive a company car, the company typically has to pay somebody else's bank. But this case, that company, my company, is going to pay my bank. So therefore, I'm going to get paid to drive company cars. And I know you guys all like this car on the screen here. It's a pretty fancy one, BMW M4. Here's how it works. You guys remember this from earlier, so I'm not going to spend much time. I have the money in my banking policy. What I'm going to do is I'm going to take a loan from the insurance company. And what I'm going to do is I'm going to buy this BMW M4. And then what I'm going to then do is I'm going to have my attorney draft a proper lease agreement. And I'm going to show you like the numbers behind this. I'm going to do a lease agreement from my bank to my company. And then my company is then going to have this BMW M4 sitting in the company parking lot where I can go and I can drive this car anytime I want. I don't have to pay for the car because my company is. The rental income that I get from my real estate portfolio, that income that comes into my company is now going to pay for a company car. But the cool part is my bank, my personal bank, owns the car, but it leased it to my company. So why would I ever do that? Well, again, you want to mimic as many things as you can that the regular bank does. And the regular bank, the last time I checked, are making a bloody killing on leases. Why? Because they're charging interest and they're keeping the asset. How many of you would love to be able to charge somebody for something, but then at the end of the term of whatever that is, 3 years, they give you the thing back, but they paid for it already? How many of you would be okay doing that? Folks, just look at what the banks do. This is what they do every day. These are real cars that I've owned, that I've actually used my banking policy to buy. So I just said, well, let's just use examples. What if all I did is I took one additional step in these cars and I leased these cars to my real estate company? Car number one was an Audi A8. $20,000 is what I paid. After 5 years of the car, I would have had a residual value of about $8,000 in the leasing agreement, and APR of 8%, which, folks, if you think that's high, you should really look at the fine print in your lease agreement on that car that you're leasing, because I bet you any money you're paying about that. My monthly payment would only be $297, but I'm not going to make that payment. My company's going to make that payment. 100% tax write-off for my company. Why? Because a lease, the reason your CPA a lot of times suggests you lease vehicles to get the write-off. I want the write-off. I don't want to pay the government taxes. Over 5 years, if I leased this A8 the way that I just explained, my personal private bank buys the A8, leases it to my company, agrees with my company to make that my company's going to make a payment of $297 a month for a period of 5 years, meaning they're going to pay $17,799 over 5 years for this Audi A8. The interest charged on that lease was $5,799. Folks, this is what you're paying on your leases. You've just never looked, because we did this with software that is specifically designed to show this. And then all I do is, you think, guys, an Audi A8 after 5 years, you think it's worth more than $8,000? Remember that. I would say so. How about lease number 2? How about this? Audi S4 Avant. Okay, 45 grand is what I paid. Residual value after 5 years of 18. So 8%, that's a 667. Why do we lease cars? Because the monthly payment's lower. I get to drive an A8 and my company pays $297. My company doesn't even know it's missing $297 a month, and I'm driving that car. Sweet. This car in the middle, my company's paying $667. Why is it lower? Because there's a residual value built in. That's why over 5 years, I will tell you for a fact, this S4 Avant would sell after 5 years for a heck of a lot more than 18 grand. And I want you to remember, the residual value isn't what the car is worth. It's what we say it's worth. If we can sell it for more, well, that's profit in our pocket. Okay, lease number 3. This is actually my wife's push gift, but we're just going to use it. 63 grand, Porsche Cayenne. It's a Cayenne S hybrid. Okay, $937 lease payment my company makes. So come down here and let's look. This is actually a policy of mine. We used as another example. If I did that right here, year 3 of my policy that I'm putting 18 grand in, not 30, this is a different plan. 18 grand, okay? I take 20,000 out of my cash value, which would have normally been 40,603, and I buy the car. Then I lease that car for $297 to my LLC. Remember, all I do, it's just a lease agreement my attorney does, and I lease it to my LLC. I own the LLC. So I'm driving a company car that is leased from my personal bank. $297, 100% tax write-off. Check with your CPA to make sure that that's the case, but I'm pretty darn sure it is. And then here, after 7 years, when I'm sick of driving that Audi A8, I'm ready for a new company car. I have put $126,000 into my banking policy, 18 times 7. I have paid lease payments or taken on lease payments from my company totaling $17,799. I bought the car, 20 grand. So my total net injection into my banking system was 123. My cumulative cash value after year 7 is 136. So you can see I made 110% on that process on leasing a car to my company. But oh wait, it gets so much better. Let's go to the second car. This is where it gets like just wild. Okay, I bought that S4 Avant, 45 grand. I leased it to my company for 667. My company got to write that 667 off every month. I got to drive a car for free. Not really free, but my company is providing me a company car that they're getting a write-off for. And over the course of these years, 8 through 12, I deposited 68.4. My lease payments were $40,020 that I received from my company. The car cost was 60 or 45, so my total net injection was 63,420. Don't get hung up on the numbers. We do all this for you. I'm just trying to show you in full transparency how this would look. My cumulative cash value in year 12, after that lease is up and my bank takes the car back, and folks, just so everybody knows, this is kind of funny. You remember the S4 was parked in the company parking lot. Now it's just parked in my home parking lot. I own the bank. Like it's kind of silly. I have 284,000 and I now made 449%. Net gain on that car, $1,798 plus. Can I sell this S4 for more than 18 grand? Absolutely. Whatever I make above and beyond 18 is pure profit. And the Porsche, let's go into that one and we'll wrap it up with that. Whoops, went too far. Here's the Porsche, same thing. Year 13 of this policy, 63, and see how it dropped? It went from 18 to 7,200. That's what I'm talking about with that MEC rule. 63,000 for the car. Damn thing. There we go. Lease payments were hefty, 937, but go try to lease a Porsche right now and tell me what your lease payment would be. I'll bet you any money it will be about that much. And a $63,000 car. Go do the math. 63,000 on the car, leased for 937. I put in 36, which is 72 times the 5. I then took on lease payments from my company of 56. I did buy the car, so my net injection was only 29. I mean, this is just starting to get silly, right, folks? This is only 3 cars. What happens when you keep doing this? I'm only 17 years in, 3 different vehicles, 1,491% return, 435,000 in my bank now. I made $2,480 for that on that, just on driving a company car. And I still have a residual value of 25. So if I sell this car after 5 years for more than 25, which indeed I can, that's pure profit. Here you go. I made $5,700 or $5,077 total net gain. Okay. After all costs of everything. The only thing that's not included in that net gain is the attorney's cost for drafting the lease, plus the profit from selling the car, which whatever that is, I get that money. Plus you didn't have to pay $37,077 in interest to someone else's bank because you paid it to your bank. Folks, like if that didn't get you excited, then I think I need to really, I need to have my head examined. I really do, because when I read this in the book and I had Andrew in the mapping department run the numbers behind this, just like he would for you, I freaked out, folks. And, you know, I feel like sometimes I feel like I've seen it all, but when I saw that and I ran that, I'll assure you I hadn't seen it all. What'd you guys think of that? I know that was a lot of stuff. I got really pumped up and I maybe went a little too far with it, but like that leasing thing just gets me fired up, man.
Let me ask you a question, Chris. If I have a lot more money in the bank and I want to pay myself, if I want to move it from a regular bank to the bank of me to be able to do this, what is there a limit to how much interest I can pay myself back on certain items?
Yeah, so you got to be careful, you know, when you're doing this where you're lending money and, you know, how much you're charging yourself, like in the lease thing, you can't really charge yourself. Like if you were going to take money from your bank and lend it to your real estate company, you can't really charge your real estate company more than what you could get money from the bank. Otherwise, the IRS could audit you and you could get in trouble there. And when you're recapturing the money, can I take all that interest that I'm making and put it all back into that same policy? No, I can't. So a lot of that money is going to sit in that segregated bank account, which is exactly why I have 7 policies. I've built this to the point where I've got money moving all the time, and some of the interest I'm making on private loans, on real estate deals, stays in that segregated account. And I can't put it back in my policy because I can only put in what I take out of the policy. There's limits. So as that segregated account gets more and more money in their bank, I just open additional branch offices, and then I take the money from the segregated account and I put it back into new policies. And I showed you kind of how I did that with that college loan without having to open new policies. I just took a loan, paid for college, and then I just took the money from that bank account and paid that loan back. So same idea.
Got it. Okay, so you can't take some of the extra profits, those net gains, and put it in there. You got to pay yourself back the exact amount you took out.
Yeah, and you could add on the 5% that the insurance company charges. You could put that back in as well.
Perfect.
What about, Chris, for example, you start a policy, right? Like you said, you start a policy, you're going to put $30,000 in a month. You realize, hey, I should have put like $50,000 a month, right? Is there a time frame on when you can start your next policy?
Yeah, like 30 days.
So I can start one.
I've had lots of people do that. Like they start one, they're like, oh, crap, I should have put more in. And then we just start the second one.
Got it. Okay, got it. And kind of break down how I can have a policy, right? Let's say for my 5 kids, they can each be a beneficiary, but I'm still the owner of the policy, correct? So I still control it. It's just different beneficiaries that would benefit from the death benefit.
Precisely. I mean, when you own something, you control it. I mean, in ownership comes control. That doesn't mean that you have to be the insured on each one. Like I said, I started a policy for Vivi, my daughter, and I put $5,000 into it. I own that. So whatever cash is in that plan, I control that cash. Now I can use that for things for Vivi. I could use those for private lending, and I could teach Vivi, hey, listen, this is your bank, sweetie. And what I'm going to do is I'm going to teach you how to use your bank. And what we're going to do is we're going to lend a little bit of money to this nice man, Jory, over here. He's buying a real estate deal. So you're going to be the bank and you're going to be really nice. Vivi, how much you're going to charge Jory? No, you're not going to charge him 15%, Vivi. Be nice. Fine, you'll charge him 12, and you might accept
Thanks,
that.
Vivi. Appreciate that.
You see, like, think of like the possibility of what you could teach your kids if you just simply taught them how to be in control of their money and how to be the bank. It's nothing different than what we all do today, but we use the bank's money. And if all we did is just flip that switch and we used our money instead of the bank's money, we now take back all the banking functions in our lives. Teach our kids this. That's powerful.
So if someone's like has a health risk, right, and they're uninsurable, they can still own a policy, but it would be insured by somebody else. They would insure someone else.
We do it all the time. So, you and Kevin are business partners. So you each have an insurable interest in one another. So if Kevin graduated too early, you would have a financial loss for that. Or if you graduated too early, Kevin would have a financial loss. Each of you could take out a policy on one another, be the owners of each other's policies, control each other's policies, and then have beneficiaries being whoever you want. It could be the company. It could be the other party's family. You could do all sorts of really cool stuff with this.
Got it.
Chris, if people are sitting here thinking that they need $30,000, $40,000, $50,000 to start, what do you have to say about that, and where should they be going right now if they don't need 30,000, 40,000?
Yeah, well, you certainly don't. I mean, remember, folks, these are just my examples. My smallest policy is $200 a month. That's my smallest policy that I started many, many years ago. But you saw two additional policies, one that I'm doing 18, one I'm doing 30. So here, just write this down, everybody. The minimum amount you can put into your policy is your age times 10 a month. Okay, so I'm 43 years old. Times 10 means $430 a month. $430 a month today would be my minimum amount to start one of these banking policies. So whatever your age is, folks, just take that, multiply it times 10. The number you get is your minimum monthly. So if you're in your 20s, $200 a month might be the right number.
Chris, for anybody that's got further questions and they want to talk to you more about their own personal circumstances, where can they basically connect with you?
Yeah, it's super easy. Just go to my website, which is Chris Naugle. I think it's right there, chrisnaugle.com. In there, there's a free resources tab. Scroll down one or two, swipes of the index finger to book a call with me and speak to me. It's mandatory that you watch a 90-minute video. It's like, that's just the barrier of entry. So watch the 90-minute video, scroll down, and there's a schedule a call link. So everything's right on my website. You can watch all the training videos, and you can schedule a call with me or my team to talk about your situation, your money problems, and how we can solve them using privatized banking.
Awesome.
And then next month, we're back at this again. Chris, you got more for us?
Of course, I got more for you. I've got a whole different training I'm going to be doing, but it's not going to be as vast as this one. Next month is going to be one particular thing, all real estate, and that's all we're going to talk about is how to use this to buy your real estate deals.
Perfect.
Appreciate your time, brother.
All right, guys. Thanks so
again,
much.
Chris.
Okay.